Beware of the debt death trap and how to prepare. Now, in Jim Rickards' new book, he explains in great clarity what is going on with the US dollar, how it's going into what he calls a debt death trap. Now, in this video, I'm gonna explain what that means. I'm gonna explain how we got here, what this means for us right now, how this all ends, and most importantly, of course, the assets that he recommends that we stay away from, as well as the assets he recommends that we go into to protect ourselves, to protect our wealth. So let's go. All right, welcome back. So my name is Mark Moss. If you're new to the channel, welcome. I like to talk about money. I like to talk about the financial system. I like to talk about how since we got off of a hard sound money, it's just created problems that get worse and worse and worse. Now it's important to focus on this because if we want to have more options in life, then we have to be able to manage our money, especially as we go through this transition, what I call the great wealth transfer. Now today we are talking about downward spirals. Now downward spirals happen in lots of different circumstances. Sometimes you may call them flywheels. I call them sometimes self-fulfilling prophecies. You could think about it as a snowball going downhill that's getting bigger and bigger and bigger. Now the definition of a downward spiral is something continuously decreases or gets worse. So that's basically what we're talking about. Now a good example of this is I did a recent video talking about Wall Street bets, talking about the silver short squeeze. And so I talked about it in that video. I went back into history, as you know I love to do, and we talked about the Hunt brothers. And the Hunt brothers famously tried to squeeze the silver market back in the late 70s, early 80s, and they basically put all their money, billions of dollars, into silver. In addition, they leveraged the market through futures and whatnot, and they drove the price of silver all the way up to about $49. Now, the price of silver started coming down, and this is the downward spiral. So as the price came down, because they were using leverage, they had to cover their shorts. In order to do that, they had to sell some silver. They sold silver, raised the money, covered their shorts. But as they did that, that caused the price of silver to come down more. They had to sell some more to cover the short, which brought the price down more, which made more people start selling, which brought the price down more, and it became a downward spiral. It ended up going from about $49 an ounce all the way down to $11, that downward spiral. And that's what we're talking about today. Of course, we are talking about the death of the debt spiral, the dollar spiral. Now, the debt trap is nothing new, all right? You can see right here, this is written by Nouriel Roubini. He is a big-time Bitcoin bear. He's just an overall market bear in general. He wrote this back in 2010, and he was talking about Greece, all right? Now, we're gonna get back to Greece a little bit later, but right now, there's other countries doing it, like Greece, which we'll talk about, but also the point is that the US dollar is entering the same type of trap right now. And once you're in that trap, you're kind of at the point of no return. Now, how do we get here? Now, we got here, of course, through taking on massive amounts of debt, massive amounts of money printing. Now, since the beginning of time, governments have spent more than they've taken in. It's just human nature. They don't control the budget. It's not their money. And so, of course, they're going to print and print. They're going to spend and spend and spend. The Roman Empire debased their currency, and every government has always done the same. Now, in the United States, and really for the world, the entire world was on a gold standard, especially from 1944. And then moving forward up until 1971, the entire world was on this US dollar gold standard. Now, after 1971, President Richard Nixon severed the gold tie, which meant that no currencies in the world, all fiat currencies were now free floating. There was nothing backing them. And of course, it's easy to see what happened. You can see on the chart on the screen that debt had pretty much remained the same. It went up a little bit here in the 40s after World War II, and then it pretty much stayed flatlined until, look at this date right here, 1971. Of course, since that time, it has ballooned up, and look how high it has become. It's incredible. And so that's how we get here. The governments are printing too much debt. They're taking on too much debt, and there's just not enough growth. So it's the debt to growth. So we're going to talk about that. Now, at the point we're at right now, it's just never ending stimulus. And that's what's really taken us there from 1971 until today. Every time there's a financial problem, they print more money. And you might, if you were managing your own budget, you might go, well, shoot, I'm out of work right now. I don't have any money. Let's live on our credit card. And we're going to live on our credit card just temporarily. And of course, once I get a new job, once this payment comes in or whatever it is, then we'll pay it off, right? And that's what the government always thinks. but of course they never do. They always continue to print and more, and they're hoping to bridge that gap, and then once the economy starts to grow again, once you get a new job again, they'll pay it off, right? But it just never comes. Now, in order to keep this game going, they have to move interest rates to zero. And so we've watched interest rates basically just steadily decline, and they're basically at zero right now. In addition to keeping rates at zero, they have to inflate the currency. They have to continue to debase the currency. By doing that, it makes the debt inflate away. They basically pay it off through inflating the currency. Now, of course, they have to keep the interest rates at zero, just like if you were living off your credit card. Imagine if your credit card company raised the interest rates. You wouldn't be able to service the debt. And so by lowering the interest rate, it makes it easier for them to take on more debt and basically get it for free. They don't have to service the debt. Now, the spiral only continues to accelerate. And right now we are watching it accelerate at a rapid pace like we have never seen before. As a matter of fact, to put this, to kind of put this little bit of perspective, we just had $1.9 trillion budget pass through. $1.9 trillion budget. And that is to, of course, bridge the gap, right? The economy's not growing. People still aren't back at work. People aren't getting their bills paid. Everybody needs help. And so, sure, let's give them a $1.9 trillion bailout bill. And hopefully that will get the economy to grow, right? The problem is, in the same bill that they're sending out money, they also are doing things to kill jobs. So, for example, they reversed the Keystone XL pipeline. Now, whether you like it or hate it, doesn't really matter. The point is that by killing that, by taking that out, it will kill tens of thousands of jobs. So at the same time as they're putting us more in debt, putting the country more in debt, trying to get growth, they're also killing jobs at the same time, which of course accelerates the spiral. Less growth, more debt. Now, to put that into perspective, of course I always like to do that. In order to put that in perspective, think about the size and scope of how big this is. Now, we haven't seen any type of bailout this size or scope since FDR back in World War II. Now, back then, he was trying to bring the country and kind of the world, but the country out of World War II. He was directing the entire economy for the war efforts. So maybe it was more needed than it is today. Now, again, to put this into perspective, we just got $1.9 trillion. Now, in 2008, which was the great financial crash, the entire world's financial system was crashing. And in order to bail it out, we had a $700 billion bailout. Now, at the time, in 2008, I remember thinking, oh my gosh, that's so much money. There's no way. The government's never done anything like that before. That was $700 billion. Today, they're throwing around trillions, almost $2 trillion, like it's no big deal. And so that just puts it into perspective. Now, that's $1.9 trillion on top of $900 billion that they just put through last month, almost another trillion. All right, that's almost $3 trillion. And just this year. On top of that, they just passed $3 trillion in April and June of 2020. On top of that, the deficit in the budget, that's how short the budget is, right? They can't pay back to if you're spending more than you're making, right? So the deficit is another trillion. So between 2020 and 2021, the total deficit is $8 trillion. It's a lot of money, and that is only accelerating the spiral, which we'll explain in more detail. Now, that's not enough. There is more coming. We know that there's more coming because obviously the economy is not roaring back to life, because there's all these policies that they want to fund. And of course, they're telling us. Here's Janet Yellen, the new head of the Treasury, U.S. Treasury, and she says that we need to, quote, act big. Act big. So apparently 1.9 trillion is not big enough, and she wants even more. So it's going to be pretty crazy and interesting to see what happens. Now, where do we go? Does the 1.9 trillion just automatically make everything better and all of a sudden the economy is growing again? Well, some people think so. As a matter of fact, the Wall Street Journal says that the economy is set to roar by the summer of 2021, which sounds great, of course, right? The economy just comes back to normal. We put a 1.9 trillion in. I mean, that's what they're hoping for. Stimulus, right? To stimulate the economy. Here's the thing though, just because we have been holding back on things doesn't mean we're going to automatically go get those things. So let's say you normally go out to dinner twice a week. All right, that's 100 times you might have gone out to dinner. You're not going to automatically go out to dinner 100 times to make up for that, right? Those dinners are gone. Or let's say that you take, I usually take one trip a month. Well, I haven't taken those trips. I'm not going to all of a sudden go take 20 trips. So that's gone. We don't automatically come back. Of course, the TV commentators want to tell us want us to believe that the economy is going to roar back to life. But the fact is that the stimulus plan ends up hurting growth. It ends up hurting growth. It ends up destroying jobs, and it's going to put us into a new recession. It's like, it's all that debt. It's like putting a backpack on full of rocks, and you're just going to walk slower. It's heavier and heavier. Now, Jim Rickards says that we should expect deflation. That means the economy to continue going down into the end of 2021. And that would be followed up by inflation in 2022. So this is in line with a lot of things that I've talked about, what I've shared about other analysts, that we'd have a deflation first, and then the response to that deflation would then cause inflation to go sky high. But let's take a look at why he thinks that is going to be the case. Now, he talks about the twin pillars of destruction. Now, the twin pillars of destruction would be monetary policy. So this is what the Fed can control. The Fed has monetary control, and so basically they can control interest rates and they can control money printing. So interest rates, of course, going to zero. We've talked about that. They have continued to lower rates lower and lower and lower, and they have to. They can't raise rates because they have so much debt. And so when you start having runaway inflation, typically you would raise the interest rates. But if they raise the interest rates, how can they pay for the debt? That's the problem that they find themselves into. So they're stuck with zero rates. And of course, the second tool that they have with monetary policy is money printing, or basically what they can do is put reserves into the banks, and then hopefully they hope that the banks will spend that money into the system. We're a debt-based system, and so the banks will create that money into the system by giving loans for cars, houses, credit cards, things like that. Now, the second pillar he talks about is fiscal policy. Now, fiscal policy is what the government can do. So this is deficit spending. They can spend more money than they're bringing in. This is, and that's the things they control. They can get money out directly to the people, and that will lead to higher debt to GDP ratios. Now, the debt to GDP ratio is something that we want to watch. There's a key number. We're going to talk about that in a second. Now, this is only exaggerated by higher taxes, lower wages, and more regulation. All right. So when all this happens, when we have massive deficits because of all the debt that we've created and we haven't gotten the growth out of it, they raise taxes. So we see this happening all the time. It's one of the reasons why I had to leave California. They already have the highest taxes in the nation, and now they want to raise them again. They'll be double the second highest state in the country. We see that in New York. That's why all of Wall Street is leaving New York and moving to Florida, because of higher taxes. And of course, and when taxes go up, businesses can't afford that and they have to pay lower wages, and then we get more regulation. So it just creates this downward spiral. We're already seeing the regulations come out. Part of the mandates, of course, is to fight income inequality, and so they want to start putting price fixing, things like that. After the Wall Street Bets Reddit fiasco that we've had over the last couple of weeks, we've seen Senator Elizabeth Warren come out talking about more regulations, and she thinks that we need to crack down on the individual retail traders, not the hedge funds that caused the problem, but the individual retail traders. I've seen some pretty crazy things. I'm not going to get into that on this video. We might talk about that on another video. If you want to know more about the regulations that they're talking about putting in, go ahead and leave me a comment down below, and we'll get into that. The real problem that we have, though, and the reason why we're getting into this death spiral, is because we have no velocity. Now, the velocity basically measures how fast money moves through the economy. It's kind of summed up by this formula that we have here, which is the velocity of money equals the amount of money that moves through the economy. So basically, if I bought something, I gave it to the store owner went and bought something at the bakery person went and bought something at the flower store. So that same dollar moved through 4 or 5 hands, all right? The same dollar. And so the faster that happens, the higher the velocity goes. But if I decide not to spend, if I decide to save, then it doesn't go anywhere. And that brings the velocity down. And that's exactly what's happening. There's no velocity. And the monetary policy, it fails because there's no velocity. So the monetary policy, what the Fed can do, they can give reserves to the banks. But if the banks aren't loaning that out, or let's say they do loan it out and then people hoard it, they don't have the velocity. Now, the velocity, how fast the money was moving through the system, peaked in 2008. And of course, if you were alive before 2008, or if you were working and investing during that time, you remember that the world was going great. everybody was rich. People were buying houses like crazy. Equity was in your house. People using it like credit cards, putting pools in, buying RVs and boats and vacation homes, and everybody was spending money like crazy. But when the great financial crash happened in 2008, everybody contracted, right? Nobody had money to spend. Nobody was buying swimming pools and RVs and boats. And if you did still have some money, you didn't want to save it. You wanted to hang on to it. And so we started seeing the velocity of money dropping after 2008. It's continued to fall. And then, of course, as you might imagine, in 2020, right off a cliff. 2020, the pandemic happened. 50 million people in America were laid off. There's no end in sight. 14 days to 15 days to flatten the curve is now turned into an eternity. And so guess what happens? People don't want to spend. They want to save. In addition, even if you do want to spend, there's nowhere to even go spend your money. And so, of course, the velocity continues to fall, which is why the Fed keeps printing money. They're trying to get that velocity up. But as I just said, the Fed has no control over the velocity. They can't do that. All they can do is give reserves to the bank. And so this enters the death debt trap. We're not in the spiral yet. This is the trap. So the trap that we're in is something that we have in common with these countries. So Greece, Lebanon, Italy, Japan, and now the United States. All of us have something in common. And what that is that our debt to gross domestic product, the debt to GDP, is over 125%, which is a very key number I'm going to explain in a second. And basically, the more that we spend, the worse this gets, right? Because the debt level keeps going up. The GDP is not going up, but the debt is, and that 125% is on its way to 130%. And that is, the problem is Keynesian multiplier, all right? So the Keynesian multiplier basically talks about this debt to GDP. And it tells us that the ratio, the debt to GDP ratio, is a very significant number. And really it's at 90%. That is the threshold number that we want to look at. When countries have less than 90% debt to GDP, they can borrow $1 and spend that dollar into the economy and get more than $1 worth of growth. So they borrow $1, put it in the economy, and they get about $1.25 of growth, which is good. Problem is that as the multiplier drops and the ratio gets higher, then it becomes harder. So then when the ratio gets over 90%, then they're going to get less than $1 of growth. So now for every dollar they spend, they get 75 cents of growth or 80 cents of growth. And that is what leads to the death spiral. Now, the US crossed the 90% threshold back in 2011. So it's been about 10 years at this point that we have been above that threshold. And that's the problem that we're in. So the death spiral means that we're spending more and more and more, but we're not getting enough growth. So all it's doing is making us deeper and deeper and deeper, because at that point you can't borrow your way out of it. If I can't get more growth than what I'm borrowing, then all I'm doing is making it worse and worse and worse, which means that the economic system is built on a ticking time bomb at this point. The velocity is dropping, the debt is growing, and the growth is slowing all at the same time, which is the death spiral that we're in right now. Now, what does Jim Rickards have to say about this? How does it end? And what should we be doing about it? Well, he talks about that there will be an explosion in the form of asset bubbles bursting. Now, a lot of people, the Fed, of course, says that there is no inflation, right? Their target is 2% inflation, but they can't get inflation. The news tells you there's no inflation. And all this money was printed and it's not causing inflation. Well, where the inflation is in assets. It's asset bubbles everywhere we look. As a matter of fact, just take a look around. You can see them, all three stock indexes, all-time highs. Real estate, all-time highs. Land, real estate, all-time highs. Collectibles, cars, all-time highs. All types of assets are at all-time highs. And so that is what he's saying. There will be an explosion in the form of asset bubbles bursting. So what does he recommend that we do about it? Well, he recommends the same thing that I basically talk about a lot on this channel. He says to watch out for stocks, because those are massive overvalued bubbles. He talks about watching out for commercial real estate, which of course makes sense with all the layoffs, with the change in the pandemic, with people working remotely, specifically commercial real estate, office buildings, things like that are going to be dangerous. He says to watch out for bonds. All of those things will be crashing. He says that he likes, of course, hard, real, tangible assets. I talk about this. So as there's an unlimited amount of money printing, fake fiat counterfeit money, people are going to want to buy real, hard, tangible things. Of course, he says, watch out for gold prices to take off. He likes gold. I talk about other hard, tangible things. Maybe Bitcoin isn't tangible, but is a hard asset that cannot be inflated away. Other things he likes are also residential real estate, not commercial, but residential real estate, because you can take out a loan at record low rates. And with the inflation that's happening, it's basically paying off that loan for you, just like what the government's trying to do. It's almost like free money, and of course, people are always going to need a place to live. So watch out for stocks, watch out for commercial real estate, watch out for bonds, but he likes to run to gold, hard assets, and some residential real estate. So that's what Jim Rickards has to say. It lines up with a lot of stuff I talked about. Let me know what you think. Do you see the death spiral happening? And do you see the same thing that Rickards says? Leave me a comment and let me know. Of course, as always, leave me a thumbs up on this video if you like it, because you know I'm working hard to bring this to you. If you don't like the video, well, I guess give me a thumbs down, that's okay. But leave me a comment and let me know at least why you don't like it. All right, and that's what I got for you today. All right, to your success, I'm out.